Are you fed up of seeing your hard-earned money disappear in taxes instead of growing your portfolio? In this video, I'll explain you how minimizing taxes can make your stock portfolio skyrocket. If you stick around to the end, I'll explain you how to do it legally in the US, Australia, and the UK if you want to invest in individual stocks. So let's dive in! Taxes are the biggest expense for investors. If you start with a dollar investment that doubles every year, sell it at the end of each year, pay a 34% tax rate, and reinvest everything, you'll end up with $25,200 after 20 years. If I start with a dollar investment that doubles each year and sell it after 20 years and pay a 34% tax rate, I'll end up with $692,000. Even if we started with the same amounts and at the same return, I end up with 27 times more money than you. How does that happen? To understand this gap, it's important to grasp the concept called compounding. Think of it like having a magic piggy bank. Every day, you put a little bit of money into it. Here's the exciting part. The piggy bank rewards you with extra coins just for keeping your money inside. Each day, the piggy bank gives you more coins, not just on the original money you put in, but also on the extra coins you earned from previous days. That's how compounding works. The longer you leave your money in the piggy bank, the faster it grows. Back to our $1 investment example, the extra money that the piggy bank gives me is the gain I earn on my investment, which keeps doubling each year. As the years go by, the gains themselves start generating more gains. Just like a snowball rolling downhill, your investment grows faster and faster, reaching a point where it's almost unstoppable. The reason I end up with $692,000 and you with $25,200 is that my entire investment compounds without tax reductions over 20 years. By not selling my investment, I defer taxes and allow the full amount, including all gains, to keep compounding year after year. I only pay taxes when I sell after 20 years. By that time, my investment has grown so much that even after taxes, I'm left with way more money than you. In your case, you pay taxes on your gains each time you sell at a profit. This tax payment cuts down the amount you can reinvest each year. Since you are reinvesting a smaller amount after taxes each year, compounding happens on a smaller base. This slows down how quickly your investment compounds. By selling and paying taxes annually, you miss out on the potential growth of the gains that went to taxes. Over time, this significantly reduces your overall return. Warren Buffett has referred to this in the past as an interest-free loan from the Treasury. When an investor holds onto stocks with unrealized gains, he effectively uses money that would otherwise be paid in taxes without any interest cost. I keep pointing out the power of compounding in many of my videos, and if there is one thing to remember from my channel, this is it. Albert Einstein said that compound interest was the greatest mathematical discovery in the world. Those who don't take advantage of it end up paying it to those who do. So the question is, how to legally minimize or avoid taxes to keep your money compounding at a faster rate? When you earn an income, whether from a salary or dividends, you are usually subject to income tax. A dividend is a portion of a company's profits paid to its shareholders as a reward for owning its stocks. The system that is followed in the US, Australia, and the UK is the marginal tax rate system. This means that you pay different taxes on different portions of your income that are called brackets. The government sets tax rates for those different levels of income. As you earn more, the income in higher brackets is taxed at a higher rate, but only the amount in that bracket is taxed at that rate. Even if you reach the highest tax bracket, the lower parts of your income are taxed at the lower rates from the earlier brackets. The money you get is what is left after income tax is deducted. When you invest that money in stocks and make a profit, you are subject to capital gains tax. In the US, Australia, and the UK, there are legal strategies and tax advantage options to help minimize both income and capital gains taxes. In those three countries, a simple way to avoid taxes on stock investments is to adopt a long-term investment strategy and target companies that can effectively compound your money over a long period of time. You only pay taxes on gains from stocks you have sold at a profit. If you don't sell those stocks, the gains are unrealized and you won't pay taxes on the profits. I've made a full video explaining why a long-term investing approach is key to your investing success, and if you are interested about it, you can find it in the description. Now, if you still want to have the flexibility to minimize taxes while going in and out of individual stocks, or avoid taxes on your income before investing in them, there are various options depending on your tax residency. In the US, there are 4 main retirement accounts that allow you to invest in individual stocks while optimizing taxes. The traditional and Roth 401k plans with an optional self-directed brokerage account, or SDBA, and the traditional and Roth individual retirement accounts. The availability of an SDBA depends on the 401k plan provider selected by your employer. For example, Charles Schwab offered this through their PCRA, Personal Choice Retirement Accounts. Eligibility for the traditional and Roth 401k with SDBA usually requires employment, as these plans are typically offered by employers. Traditional and Roth IRAs are available to anyone with earned income, which includes wage, salary, or self-employment income. Investment income, like dividend or interest, does not count as earned income. For 2024, the contribution limit for a traditional and Roth 401k is $23,000 if you are under 50 and $30,500 if you are over 50. For IRAs, the contribution limit is $7,000 if you are under 50 and $8,000 if you are over 50. Employers may offer matching contributions to your traditional 401k. This matching amount will go into a traditional 401k account even if you contribute to a Roth 401k. Contributions to IRAs are not matched by employers. When you contribute to a traditional 401k or IRA, those contributions are tax deferred, meaning that you pay taxes on them later in retirement. Plus, they also reduce your taxable income for the year. For the Roth 401k or Roth IRA, you contribute money that has already been taxed and deducted from your income. For all 4 investment options, you won't pay taxes on capital gains when you sell a stock at a profit. The same goes for dividends you earn as the shareholders in the company you invest in. Since those are retirement accounts, you typically withdraw money when you retire. Traditional 401ks and IRAs are taxed as ordinary income based on your tax brackets, while Roth 401ks and IRAs are tax-free because contributions were made with after-tax money. However, they are only tax-free for qualified withdrawals, meaning that you must be 59 and a half and at least 5 years must have passed since your first contribution. For the Roth IRA, this will only apply to your earnings, capital gains, and dividends, since you can withdraw your contributions anytime without paying taxes or penalties. The withdrawal age for all 4 types of accounts is 59 and a half, with the additional conditions we've discussed for the Roth 401ks and IRAs. For a traditional 401k or IRA, an early withdrawal penalty of 10% applies if you withdraw before age 59 and a half, though there are some exceptions. For a Roth 401k or Roth IRA, early withdrawals before age 59 and a half or within 5 years of your first contribution incur a 10% penalty plus regular income taxes on your earnings. In Australia, you have 2 options to legally minimize taxes when investing in individual stocks. A superannuation with a direct investment option offered by some industry super funds like Australian Super. A self-managed super fund that lets you have full control over your stock investments. A self-managed super fund usually involves significant compliance and regulatory requirements since you are essentially running a small company and need to be audited annually. Some providers, like Stake SMSF, handle the administrative side of your fund so you can focus most of your time on investing. All employees in Australia receive superannuation, a mandatory payment of 11.5% of your base salary as of July 2024 that your employer contributes to your chosen super fund. Superannuation funds with a direct investment option usually limit your stock investments to Australian shares and specific assets. In contrast, an SMSF lets you invest in both domestic and international stocks as well as other assets. If you choose to salary sacrifice, asking your employer to contribute more than the mandatory 11.5% of your salary to your super, the extra contributions are taxed at 15% instead of your marginal tax rate. For example, if you earn $100,000 and salary sacrifice an extra $10,000, that $10,000 will be taxed at 15%, which could save you money compared to your marginal tax rate. If you put money into your super after it has already been taxed as income, you won't be taxed on those contributions for either type of fund, as long as you stay within the non-concessional contribution limit and don't claim a deduction on your tax return. As of July 2024, the annual limit for salary sacrifice contributions that are called concessional contributions is $30,000. For after-tax contributions that are called non-concessional contributions, the limit is $120,000 per year or $360,000 over 3 years using the bring forward rule. If you claim your non-concessional contributions as a tax deduction when making your tax return, they become concessional contributions. When you contribute to both types of options, concessional contributions are taxed at 15%. For non-concessional contributions, there is no tax since you are using after-tax money. During the accumulation phase, that is before you retire and start drawing from your super, capital gains and dividends are taxed at 15% if the assets are held for less than 12 months. If held for more than 12 months, the tax rate on capital gains drops to 10% for both types of funds. During the pension phase, which is when you retire and access your super as a pension or regular income stream, capital gains and dividends are usually tax-free if you are over 60, up to a cap of $1.9 million on the total superannuation balance. Withdrawals are also tax-free if you are over 60, with some exceptions that might apply. Out of the 3 countries, the UK is probably the best for minimizing or avoiding taxes while investing in individual stocks. You have 2 options, the self-invested personal pension or SIP and the stocks and shares ISA. The annual contribution limit for a SIP is £60,000 for the 2024-2025 fiscal year or 100% of your earnings, whichever is lower. An extra benefit of your SIP contribution is that it reduces your taxable income for the year. The contribution limit for a stocks and shares ISA is £20,000 for the 2024-2025 fiscal year. When you contribute to your SIP, you get tax relief based on your marginal rate. This means that the tax authorities add this money back to your contributions. The amount of tax relief you get depends on your tax bracket. Basic taxpayers effectively get 20% tax relief on their SIP contributions. Higher rate taxpayers get 20% tax relief automatically on their SIP contributions and can claim an extra 20% through their tax return. Additional rate taxpayers get 20% tax relief automatically on their SIP contributions and can claim an extra 25% through their tax return. If you are a higher rate taxpayer and contribute £60 to your SIP, the government adds back £20, making your total contribution £80. You can then claim an extra £20 through your tax return, giving you a total tax relief of £40 and a final contribution of £100. For the stocks and shares ISA, contributions come from after-tax income and no additional tax relief is given. With both options, you don't pay capital gains tax or tax on dividends within the accounts. When you start accessing your SIP, you can withdraw up to 25% as a tax-free lump sum, up to £268,275. The rest is taxed at your marginal rate. With a stocks and shares ISA, you don't pay any tax on withdrawals. You can generally access your SIP from age 55, but this will increase to 57 starting in 2028. You can access your money in a stocks and shares ISA anytime without penalty. You can pass on your SIP tax-free to your beneficiaries if you die before age 75. If you die after age 75, the funds are taxed as income at the beneficiary's marginal rate. You can pass on your stocks and shares ISA tax-free to your spouse or civil partner, and it will stay tax-free. While ISAs don't incur additional inheritance tax, Their value is included in the total value of the deceased estate for inheritance tax purposes. Both options let you invest in a range of assets, including individual stocks. The information provided here is general, and if you are interested about it, I encourage you to do your own research or seek advice from a professional, as I'm not a tax accountant. This is it for today, guys. If you got value from this video, feel free to drop a like, and if you want to receive more contents like this, feel free to subscribe. Thank you all, and peace out!